This is the video to watch if your parents are worried about whether they can afford professional long-term care in order to live with dignity and not burden you or your siblings in your final years. I will go through a case study of a recent interaction I had with a potential client, share what I recommended to her, why she ultimately chose not to do anything, and the lessons I learned on how to effectively convince your parents to make positive financial changes. After watching this video, you can gain some insights into how to help your parents budget for long-term care. Now, before we get started, some disclosures. I am Jason Koh. I have been a financial advisor and certified financial planner for over a decade, and I founded Co-Planning Financial in 2021. I also happen to be a Chinese immigrant from Hong Kong and speak Cantonese and Mandarin fluently. Now, with this case study, I did change some of the information so it is not personally revealing and to make the video more applicable to more people. In this situation, I did give out financial advice to this family, but this is only after careful consideration of their personal circumstances. So keep in mind that I am not your financial advisor, so this video is for educational purposes only. And also, if you are going to watch this with your Chinese parent, make sure to turn on the simplified or traditional Chinese subtitles. And if they don't see that well, like my own parents, then make sure to set the font size to the largest possible. And one final thing before we get started. I am on a mission to help as many Asian immigrant retirees as I can to live their best lives powered by financial independence. So please hit the like button so more people can see this. Now let's get started. So we have a retired mom who is in her late 60s. She has a husband who is starting to experience signs of diminished mental capacity and might need extensive professional care starting in the next few years. They do have over $1 million in retirement savings, a paid-off home worth about $1 million on the East Coast, and also receive income from Social Security. With how expensive long-term care can be, the mother was extremely worried about her husband spending down all of the retirement savings and not leaving any for her. Now, her fears are valid because this is a fairly typical circumstance in older married couples. The husband, who tends to be older, is taken care of by the wife, and then when she is widowed, no one is there to take care of her, so she'll need to move into a nursing home. So the mom's adult child, who found me on Google and saw some of these videos, is actually quite financially literate, but needed more help with this complicated and emotionally charged situation. And despite her children's willingness to help pay for long-term care if she ends up needing it, the mom has a very strong emotional aversion towards receiving help from her children, as she doesn't want to be a burden, and that's a very common emotion in older parents. But she does experience it more strongly compared to others that I've met. It is also very important for the mom to live out her retirement in dignity and without any reduction in her standard of living. So in her final years, she would prefer to stay at home with professional help around the house than to stay in a dedicated long-term care facility. And after reviewing all of the financial statements that they provided, I also discovered that the mom owned a paid-up whole life insurance policy with about $400,000 in cash value. The husband is the first beneficiary, so he will receive the money first if she passes away. And if the husband is not around, then her children will be the secondary beneficiary. So the goal for them is to have a way of securing the mother's ability to pay for her own long-term care so she doesn't have to be dependent on her children and on her retirement savings. From a mathematical standpoint, I think they were in a pretty decent financial position. But the other problem is that the mother is a very anxious person and her anxiety is starting to affect her ability to enjoy her retirement. So she wanted a very clear-cut strategy for how to afford her own long-term care, whether she chooses to stay at home or to move into a nursing home. So the strategy also needs to be flexible. So when I was working on the financial plan, I had some constraints that I had to deal with. Knowing that the retirement savings might be gone by the time the mother needed long-term care, I couldn't use that as the primary source of funding. So that leaves the home, worth about $1 million, and also the cash value in the whole life insurance policy, worth about $400,000. Let's consider the home. With it being worth about $1 million, that is a large amount of equity to tap into. If the mom ends up being widowed and chooses to move into a nursing home, then she would no longer need her primary residence, and then the home can be sold to pay for the nursing home. But there is some downside to this strategy. There can be some sentimental value. Selling a home will usually cost you about 6 to 10% of the home value in commissions and various fees. But the two most important downsides are taxes and time. So first, let's talk about taxes. The home was bought a long time ago, for $100,000. So there's over $900,000 in unrealized capital gains. Now, the government does give you a tax break when you are selling your primary residence at a gain. And because we are assuming she will be widowed when she sells her home, she will only be able to exclude $250,000 in home appreciation from long-term capital gains tax. To make the math simple, assuming a 15% long-term capital gains tax rate and a 5% state tax rate, right when the mother needed the money the most, they will be taxed $130,000. And the math is $900,000 of capital gains, $250,000 of it is excluded, so $650,000 of capital gains on a 20% total tax rate. And if the home were to be kept and inherited by the children, and the step-up in cost basis rule would mean that the home is inherited with a refreshed and updated cost basis of $1 million instead of the original price of $100,000. And then when they sell, they don't have to worry about the $130,000 tax bill. So there is a huge tax cost to needing to sell the home to fund long-term care expenses. And secondly, let's talk about selling the home. It just takes a lot of time. You might need to spend 1 month hiring contractors to fix up the home to give it curb appeal. You might need another month to list it for sale and to find a buyer, and 2 months from when you accept an offer to actually closing and receiving the sales proceeds. So we're talking about maybe having to wait for 4 months to have the money available to pay for long-term care. And if you're trying to get money faster, you might need to sell your home at a significant discount because you are selling it as is with no additional repairs, and you can only accept cash offers because you cannot wait an additional month for the buyer to get their mortgage approved by the bank. The cost of being forced to sell a home to pay for long-term care can be very expensive. And finally, keep in mind, the mom prefers to stay at home in her final years and to live in dignity. So selling the home is not the preferred method in the first place. Being able to stay at home in your parents' final years is more important than you may realize. Because once you've lived in a home for decades, the routines you build, like the friends you have, activities you do, the food you eat, and even the air you breathe becomes a part of you. And being removed from that setting, the body and the mind of an elder can resist strongly to this change, and it could be very unhealthy for them to go through this transition. So that only leaves the cash value in the life insurance policy that she owns. The policy has about $700,000 in death benefit and $400,000 in cash value. $700,000 sounds really good, but it only benefits her children and not the mom. Also, the $400,000 in cash value can't be spent down in case the husband ends up depleting the retirement accounts, because legally, the mom can't get away with not paying for her husband's care when she has money in her name. So we needed a way to transform this $400,000 life insurance cash value into a financial instrument that can only be used for paying for the mom's long-term care. So I called an insurance agent that I trusted, who also happens to speak Cantonese, to run a quote for a hybrid life and long-term care insurance policy using the cash value available in the whole life insurance. So here is what she came up with. It is a policy through Nationwide, and it is a life insurance policy. You can see that in fine print here with cash indemnity long-term care benefits attached to it. So the indemnity plan means that you get to spend money however you wish to. You can choose to spend it on paying for in-home care, or you can choose to pay it for long-term care facilities. For in-home care, you can pay your neighbors, you can pay your family members, or you can pay for professional help to come to your home. And it doesn't really matter how you spend it. And another distinguishing product feature is the guaranteed premiums. For a lot of people, when they buy long-term care insurance or any kind of insurance, they're really worried about spending all this money on premiums and not getting any of the value back, because the thing that you were wanting to insure against just never happened. So what the guaranteed premium does is that irregardless of whether you use the long-term care benefit or not, somebody will get the money that you put in back. So the total premium that will be paid over 10 years into this policy will be $264,271. If the insured passed away earlier than expected and never actually ends up needing long-term care, then the benefit of the life insurance kicks in, and the beneficiaries that are listed on the policy will get this death benefit back. If the insured is in a position where they haven't used the long-term care benefit and they are obviously still alive and they are needing money for any reason, they can also choose to surrender the policy and get $116,000 back as well. It's not good to treat it as an investment because obviously you will not get back the money that you put in if you surrender it early. Don't treat it as an investment. Treat it as a long-term care and life insurance policy. In a little bit more detail, so the premiums that the insured will pay is $26,427 from year 1 to year 10 for a total of $264,000. And the total long-term care benefit starting from day 1 after paying the first premium is over $500,000, which sounds pretty good, but keep in mind the speed at which you can receive the long-term care benefit is capped. There is a monthly limit of $6,944, and it will be continued to pay as long as you are still needing care for up to 6 years. For most people, the average stay in the long-term care facility is about 2 years. And what this policy is intended to do is to insure against those outlier cases where you end up being in a long-term care facility or needing in-home care a lot longer than the average, because the average is easy to plan around. It is those outlier cases that we need to insure against. And there is an inflation protection of 3% compounded. And what this allows the policy to do is that starting from day 1, it starts with $6,944. The next year, the benefits will grow by 3%. The next year will grow by another 3%. So by age 80, when the policy may actually be claimed because the person needs long-term care, it will grow to be $9,901. But this really isn't an investment. This really is just to preserve the value of the insurance, because the increase in long-term care cost will likely be 3% or higher, as we've seen in history. So how this product works is that there would be a total premium paid of $264,271, and it is a combined 2-year plus 4-year, or combined of 6-year benefit. And for 2 years, it would total up to $166,667. And the 4-year benefit will be $350,000 for a combined of a little over $500,000 starting from day 1. And I made a note here to discuss that the long-term care claims reduces the life insurance payout dollar for dollar. So there could be a scenario where the insured ends up qualifying for long-term care and the insurance starts paying out the $6,944 a month, and they pass away after receiving that money for 3 months. And so what happened is that the insured received $20,832 in long-term care benefit, and that reduces the death benefit dollar for dollar. And the death benefit, again, is just a return of the insurance premium that have been paid. So let's say at 80, they start claiming it and they pass away, it will be $264,000 minus the $20,832. So then the beneficiaries will then receive $243,439. And again, this is not the ideal situation for you to just receive 2-3 years worth of benefit and you're just getting back your premium back and nothing more. But what this insurance really is intended to do is to cover those outlier cases where the cost of the insurance ends up being a lot higher. Because if someone does need long-term care for up to 6 years, and this insurance will cover for that. So when we look at a table, you will see on this column the scheduled premium, $26,427 paid every single year. The cash value here is never going to catch up to the total premiums paid of $264,000, but it does continue to grow at a 1% guaranteed rate. The surrender value just matches the cash value, and the death benefit from day 1, even though you've only paid $26,427, the net death benefit from day 1 is $166,000. And starting at year 7, it grows a little more to $184,990, because that is exactly how much 7 years worth of insurance premiums equal. And then year 10, the death benefit matches the total premiums paid of $264,000. So these two columns show the long-term care benefit in total value and the monthly value without inflation. So you should ignore that, because what we're looking for is the total monthly benefit after inflation. And You can see starting from year 1, it's $6,900, and year 5, it's $7,800. Year 10 is $9,000. And the total benefit is just the monthly benefit times 6 years worth of accumulated benefits. The major benefit of this policy is that it will transform the existing life insurance policy, which definitely cannot benefit the mom because it will only trigger a release of monetary value upon her death, into something that becomes valuable only when she is deemed to need long-term care by a doctor. It cannot be tapped into to pay for her husband's long-term care, and it can't be spent down just because they wanted to buy a yacht on a whim. So I felt that this was the ideal solution for this family and recommended it to them. So what happened since I made the recommendation? Unfortunately, nothing yet. Despite the adult child encouraging their mom to work with me, the mom decided not to do anything at all, because financial service in her mind is just too expensive. Even after I told them that they don't have to work with me directly to buy the life insurance policy, because I already shared the contact information for the insurance agent, she's just not going to do anything. So her situation will remain unchanged, and she will continue to live with the risk and worry that she will not have enough money for her own long-term care. But what did change a lot was my own mindset and approach when working with older Chinese immigrants. I was actually a bit heartbroken about this situation because the mom opened up to me a lot about her personal life and struggles, and I felt that I was one of just a handful of people in the United States with the right combination of professional competency, ethics, experience, cultural understanding, and language skill to help her, and she still chose not to work with me. And this was the 3rd time in a row now that I had a Chinese immigrant retiree choose not to do anything I recommended because of the perceived cost of financial services. And I was battling my own internal dialogue over the decision to focus my business on serving Asian Americans, especially Chinese immigrant retirees, and how it might have been a terrible business decision because this group of people, which includes my own parents, are so fee conscious that they would almost always choose to do it themselves poorly than to pay for someone to do it well. But I do understand and forgive her choice to not do anything, because it is the exact same choice my own mother would have made. She is just as fee conscious and prone to decision paralysis. And at the moment, I'm going through my own journey of helping my parents with their rental property and with a recent car crash that my father was in. And through helping my parents and the other Chinese immigrant families who have reached out to me, I was reminded that there are a lot of Chinese immigrants who need my help, so I cannot give up on them. Otherwise, large financial companies will continue to sell inappropriate and expensive financial products like index universal life insurance policies to the Chinese immigrant community, maybe including your own parents. And after a couple of days of dealing with the low point and going through the motion, I decided that I'm going to stay committed to my original mission. But something had to change. I decided to throw everything I was taught by the wealth management industry the past decade out the window, because they seem to backfire when I apply them to the Chinese immigrant retiree community. I decided to look back at how I was able to help my own parents implement positive financial changes and apply that to how I work with clients going forward. And this includes focusing on cash flow instead of a total return approach to retirement investing, leading the conversation with product outcome instead of comprehensive financial planning, which is sacrilegious to the fee-only CFP world. I am also simplifying my fee structure to avoid decision paralysis that my mother is so prone to. And finally, I have to become comfortable with giving the older Chinese immigrants some tough love when they are about to make a serious financial mistake, and to communicate with just as much care and concern as I would if I were their own son. Now, I don't think it's the right business choice to double down on this very difficult group to work with, but I am someone who is drawn to a challenge, and I am on a mission to help the Asian American retirees, who often are the most financially vulnerable in our community. So I'll be making more videos to help millennial Asian Americans like yourself better plan for their parents' retirement. And if you want to help, please like and subscribe. I hope you stick around, and thanks for watching.